Ladies and gentlemen, good day and welcome to SIS Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Bharat Bakshi, President, M&A and Investor Relations from SIS Limited. Thank you, and over to you, Mr. Bakshi.
Thank you very much. Good afternoon, everyone, and welcome to our Q1 FY23 earnings call. Along with me, I have our Group Managing Director, Rituraj Sinha, and also our Group CFO, Devesh Desai. I hope everyone has had a chance to look at our results and the earnings note which has been uploaded on the stock exchanges and also the company's website, sisindia.com. Let me just start with a little commentary. I think broadly, we're very happy to report again this quarter our highest ever quarterly revenue, which came in at rupees 2,678 crore, which is a 12.6% year-on-year growth over the same quarter last year. So as you can see, compared to last year, the growth momentum certainly is coming back well, especially in our India securities and facility management businesses. India securities revenues are actually up on about 20.2% over the same quarter last year, and facilities management is up very significantly at 39.8% over the same quarter last year. Of course, last year it was impacted. The facility management businesses, as you know, were impacted especially by COVID. But it's good to see that the recovery coming back and coming back pretty strong in facilities management especially. On the margin front, I think as we had indicated in our last call, we do expect margins to move back to pre-COVID levels in the next few quarters. In fact, to that end, the India security business has already seen margins move up by 20 basis points over the previous quarter. So we can already see the trend starting to play out. On the international front, again, as we have been indicating for the last couple of quarters, based on what we were seeing, this quarter the revenues have been flattish since some of the temporary COVID-related work on the international front has wound down. But it's still revenue is still flat because it is being offset by segments which were earlier hit by COVID and which are now coming back. International margins have reduced from last year. Again, as we had indicated that the temporary COVID-related work which we had got last year was at significantly higher margins. So that's broadly where we are on the businesses. I think, again, I'll at least close this by saying overall, we are happy to see the growth recovering well post-COVID across all the businesses. And we are already investing for this growth that we see coming. With this, I'll hand it back for the question and answer session, please. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. We have the first question from the line of Vidit Shah from India Infoline. Please go ahead.
Hello, good afternoon, and thank you for taking my question. So my first question was around the margin front itself. So last quarter we had, indicated there were some COVID-related costs which had kept margins in the domestic business subdued. Now, I mean, my guess would be that wouldn't be there this quarter. So, I actually would have anticipated a higher growth in margins versus, 10 or 20 bits QOQ in securities. And likewise in facilities as well. So what has kept the margin subdued? Like, are there any other costs which are currently high?
So, Vijay, it's good that you referred to what I mentioned last time. There are no COVID costs this time, but I had clearly and specifically stated two things on my last call. One, that as we go back to rapid organic growth. There will be contract startup costs which will hang heavy on the margin profile. Second, I had said that as growth picks up rapidly, working capital employed in the business will increase and free cash flow will reduce. So you are seeing this trend now, and it will continue to play out for the next few quarters till we normalize back to our regular growth.
Okay, understood. So would it be just for the sake of clarity, be able to quantify the startup costs that we've incurred, or just so that we know what normalized margins are for this?
So I think we watch our margins or gross margin line, and I've been saying consistently that our gross margin has been stable through the COVID period. We are not taking on contracts at lower margins to drag down the overall margin. So our gross margin line is intact. Previously, there were a lot of levers. Again, I'll recap and jog your memory. During COVID, we had massive savings on account of travel and rental cards, etc., which were beneficial for margins. But then there were cost of PPE, there was later cost of vaccination. And last year, we obviously started to spend more money on back to travel and back to reviews and back to everything. And we've also done a massive pay review this last quarter. So I think there's been moving parts and pieces. Some have dragged down SG&A, some have boosted SG&A, and all the fluctuation happens at the SG&A level. Our gross margin is intact. That's why I'm so sure that we'll revert to 5.5-6% range. As far as splitting the raising cost, the contract mounting cost is concerned, I will ask Devesh to organize that for you on a one-to-one basis.
Sure, thanks. Just one follow-up on the gross margins that you mentioned. While they were maintained at the 77-78%, while the number that I state is the employee benefit expense in your P&L as a percentage of revenue, that has gone up as well to 80% this quarter. So is there which in your presentation
my friend, when you mount a lot of contracts, people have idle days. I have to mount a contract from 1st. I mobilize people from 28th. There'll be, downtime, we have to bear the cost of, contract mounting. There's uniform costs, there's logistics costs, there's barrack costs. There's a lot of costs which are linked to the startup of contract. So you're seeing all these fluctuations.
Okay, fine. Got it. And as you mentioned that, working capital will obviously increase as rapid growth kicks in. So is this what we can expect as the OCF to EBITDA conversion, or will it just get better from here?
I have said very clearly last time only, 100% OCF to EBITDA is not a good signal for my business. That means I'm growing too slow. We have, since our IPO, indicated that our goalpost is 50% OCF to EBITDA. We want to be ballpark in that range, and that is what we are trading towards. Okay? But please do not benchmark with 100% plus OCF to EBITDA, because that can only happen when you're not growing enough organically.
Fine. Got that. And just one last
don't know how you got 550. The 550 rupees the price for the buyback.
Right.
Buyback value quantum is 80 crores. Okay.
Right. Sorry. Yeah.
Number two, since we listed 5 years back, if you look at our track record, we have returned money to shareholders every single year. For the first 3 years, it was through dividends, and the last 2 years, it's been through buybacks. Over the last 5 years, SIS has returned more than 250 crores back to our shareholders overall. And, sometimes we do it through dividend, sometimes we do it through buyback. These are just modes of returning money, whichever is more efficient. Coming to whether it puts pressure on our organic growth requirements or our inorganic growth requirements, let me point out that SIS is maintaining a net debt to EBITDA of a healthy 1.5x. This is useful for our return on equity profile overall. And I've said this before as well. I don't intend to be a zero net debt company. I don't see that to be a very capital efficient way of running your business.
Right. Thank you.
Thank you. Next question is from the line of Sanjay from Envision Capital. Please go ahead.
Yeah, good afternoon, and thank you for giving me this opportunity. So my question was on this cash management business, which we are looking at this moment, and the revenues have been almost similar sequential basis. Can you tell me, how are we moving ahead with this cash management business, and what is the market share currently which we are holding in this market, Indian market?
So like I said before, the cash management piece, a lot of people discount the fact that SIS owns the second largest cash management business in the country. And as you can see, through the COVID period, it hasn't had a single quarter of revenue decline. And the margins are in the range of 12 to 15%, ballpark now. The pipeline is very strong. Looking at the Q1 numbers, I see that cash business could potentially be reporting its best year of growth ever in FY23, and that's demonstrated by the fact that quarter-on-quarter change in revenue, Q1 FY23 versus Q4 22, we've almost reported 8% change in revenue. So 8% growth in a single quarter. So if this actually plays out, this could be, a very exciting year for the cash business, and not just growth-wise, but also margin-wise.
Okay. And I see that margins have declined by 22%. So are we seeing some contract loss, or how is this going in, sir?
I'd request Devesh to clarify that. I think it's already there in the earnings note, but Devesh, could you please clarify?
Yeah. So on a normalized, the Q4 they had some one-off items. So on a normalized basis, we have a 22.2% quarterly increase in the EBITDA between Q1 and Q4. So if we had reported last time also, and we've included this time in the note also, that there is a normalizing effect on Q4 FY22. So you should read the normalized number and compare it with this.
Okay. Thank you so much on this. That's all from my side.
I think the important thing to note is that, somehow, SIS is valued on a SOTP basis, but the cash business is not valued at all.
Okay.
So that's some also food for thought, I guess, at some point.
Okay. Thank you so much, sir, for this.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Rohan from SIS. Please go ahead.
Hello, sir. First of all, thanks for the opportunity. I just wanted to ask, why has SIS not given any investor presentation yet? So that's my question.
Our earnings note is our investor presentation. It is published every quarter.
Sorry, but I couldn't see. I couldn't see it in your website. That's why I asked you.
It's there on the website. In fact, for the last 21 quarters, you'll find our earnings note. It's there on the website. I request my team to send you a link separately.
Okay. Thank you, sir.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Alok Deshpande from Edelweiss Securities. Please go ahead.
Hey, hi Rituraj, hi Bharat, hi Devesh. First question on facility management. Clearly, very good traction there, with 400 crores plus of quarterly number. I just wanted to understand, do you see this momentum continuing throughout the year? And what sort of contract wins, etc., that we have seen this quarter? What are we looking for? Because this is one business which has come back really, really strongly. So just some color on that.
Alok, if you remember, during COVID, I had called it out very specifically that the biggest winner out of COVID is going to be the FM business.
Yeah.
And I think that's playing out. The Q1 numbers are before you. I have seen the Q2 forecast. They will be fairly strong. Definitely all FM businesses are reporting very robust development, and I'm looking forward to possibly the best year of growth for FM in its history in FY23. Well, I'm hoping that I didn't say that too soon. I'll just wait for H1 results to be out, and at that point in time, we'll have a very clear trajectory.
Sure. Rituraj, any monthly exit number that you used to give earlier? Is there any such number for this? What the number was in June or something like that? Yeah, sure. Devesh, can you just help with monthly numbers for all business segments?
Yes. It's 143.
Alok, is ballpark 145 crores for FM for June exit.
Okay.
And for
145. Okay.
Yeah. Well, so you can basically, they're run rating 145, 150, and they have a pretty strong pipeline. And for cash, they are operating at roughly 43, 44 crores. For India Security, it is 365 crores of June exit. And for SIS International, it is I'll come back to you with the SIS International exact number, but ballpark, this is India, yeah.
Sure. And if I noted down correctly, cash you said 43 crores, right? Roughly?
Sorry?
For cash business, you said 43, was it?
43 crores? Yeah, ballpark, yeah.
Okay. Rituraj, I have a similar question for the international business also. So while it's playing out exactly the way you called out that, the ad hoc contracts going out and the sort of pre-COVID contracts coming back. So the run rate that, we have seen in quarter one, is that the sort of run rate we should expect for the remainder of the year in the international business?
Alok, could you come back again? Sorry, I missed some part of it.
No, I was just saying that for the international business, while it's playing out the way you had called out regarding the ad hoc contracts going out and the old contracts coming back, from a run rate perspective, what we have seen in Q1, is that something that
So on one side, the COVID work is declining. On the other side, the regular business is coming back. And I think revenue-wise, it will cancel out. Okay? But where it will really show up is that the margin of COVID-related work was definitely 2% higher than the regular work. It was priced significantly higher, premium pricing. So what will happen is that the international security, particularly Australian revenues, will stabilize, but the margin will go back to 4.5% range.
Got it.
Now,
so this,
the new spin, no, just hang on, there's more here. The new spin is that the Labour government in Australia has come in and they have announced a 4.5% minimum wage hike. Australia generally does 2.5% minimum wage hikes. They've done a 4.5% minimum wage hike. Okay. Now, in the long term, over 2-3 quarters, this is good news because our revenue will go up and our yield per contract will go up because, we charge the same percentage, but on a higher revenue base now. But in the immediate term, in Q2, potentially Q3, there will be a catch-up effect because we'll have to start paying the higher minimum wage now and go back and get that from customers, hopefully in, give or take 1 to 2 quarters. So that's another dimension that is going to start showing up on the margin line in Q2, potentially Q3 for the international business. But when we are able to get the price increase, all of the 4.5% as it has happened every time before, I'm very confident that Q4 international business margin line will normalize.
Got it. Rituraj. Thank you. This is very helpful.
And just to reconfirm the numbers, right from the top, 949 crores of revenue overall in June, including cash. So if you remove cash from that, it's roughly 900 odd crores excluding cash. And then you break that down further, it's 382 for international, ballpark 145-ish for FM, and for India security, it's 365.
Great. This is very useful. Thanks, Rituraj, for this.
Okay.
Thank you.
Thanks.
Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is on the line of Rohan, retail investor. Please go ahead.
Hi, Rituraj. Thanks for the opportunity again. I just have one question. I don't know if it is possible or not, but I just wanted to ask that is SIS in the backend trying to be in a certain business where they offer premium clients like security services like bodyguards and other digital services where they can offer improved security to them. So is there any plan for this type of services in future?
No, we actually avoid doing bodyguard services and other such services because we don't find that to be scalable and the personalization requirement is fairly high there. So, we actually, on the contrary, we avoid these segments.
Okay. And second is that are we scaling or are we trying to scale the business via technology, and where are we in terms of technology advancement?
SIS has done a lot of investments in technology, both on the back end and on the customer-facing side. As you will remember, SIS was the first company to completely automate its back end with proprietary softwares like ARC for recruitment kiosks, IOPS for operations management, SalesMax for sales productivity, M-Trainer for mobile training delivery. And now we are rolling out MySIS for digital attendance, which is facial recognition-based attendance automation. So on the back end, there's a lot of proprietary software that we've built, which allows us to scale. On the customer-facing side, we are continuously aspiring for more sophisticated solutioning, whether it is through use of drones in security or it is through use of higher sophisticated technology and equipment in facility management. Very recently, we made an investment in SACU for video analytics type work, artificial intelligence. So SIS is investing in the future of security through various means and also looking to enhance value add to customers through use of technology.
Okay. So, sir, do you think that in future the man power will be reduced and we will be more dependent on technology for security purposes?
Now that we are talking casually, I must tell you an interesting story which I learned from one of my friends. Back in 1948, when the first alarm was developed, it was developed by a company called Siemens. And Securitas and Siemens both come from Scandinavia, and the owners of both companies know each other. So the story goes that the Siemens owner told the Securitas owner, the manpower security company, that now I've invented an alarm. Security guarding is going to go out of vogue very soon, in 10 years. That was 1948. We are sitting in 2022, and this is a $250 billion global market with the world's largest security company, Allied Universal, holding $18 billion in revenue. So yes, technology will be used more and more, but I don't think that manpower element of security will evaporate completely. It doesn't seem to be the trend in the last 70 years.
Okay. So, okay, yeah, I agree with you, sir. And just wanted to ask one more thing, that if you want to scale the business, does it mean that we need to increase the manpower on ground? Or is there any other way to increase or scale the business in future?
It's both. No, we'll have to increase manpower required on ground, and we'll have to also use more technology. It's not either or.
So they will be going hand in hand.
Yes, I think so.
Okay then. Yeah, thank you, sir.
Thank you. Next question is from the line of Asim Barade from DAM Capital Advisors. Please go ahead.
Yeah, hi, afternoon everyone. So firstly, just a clarification on the international business margins. So you talked about Australia business normalizing and that would take margins to 4.5% odd, at least for the next 2 quarters. Taking Henderson also into account, how would international business margins look like in the near term? Would it still be sub 5%?
Yes, what we mentioned is that, as you remember, the COVID-related contracts are almost completely going off, so we are going to be back to normal levels. As Richard said, of course, the next quarter, the wage increase is going to kick in, so you can expect 2-3 quarters before we come back to that sort of normal levels.
Even because even pre-COVID, at least if I look at Q1 FY20 to Q3 FY20 international margins, that were easily over 5%. In fact, maybe closer to 6% as well. Maybe there is some benefit coming from currency, I'm not sure. But was this business always a sub 5% margin business with Henderson in?
I think the right way to look at it is, if you look at it from a FY18 onwards, the rolling basis, you will see that this business, international business, was always a sub 5% EBITDA margin business till FY20, when we made acquisition of Henderson, which at that point was reporting higher margins. Subsequently, when we bought in, subsequently COVID impacted, and then obviously it's been wobbly. But on Henderson alone, the margin has taken a massive haircut because there was a lot of non-compliance in the business that we discovered only after the exiting promoter left the business entirely, and all that happened during COVID, because we just bought Henderson just a few quarters before COVID, and then during COVID we bought out the outgoing promoter, we put in place our people, we figured out that we are non-compliant in a lot of ways, we put all those costs back in the business, we also lost some contracts. Net summary, Henderson is a loss-making business as of today.
Oh, okay.
Right? It is under fixing. The good news is that Henderson alone earned more than $30 million by way of grants from Singapore government. So today, Henderson on its own balance sheet has more than $25 million of surplus cash sitting, and I believe that money is adequate to rebuild the business to a higher revenue in a more profitable way. So the bad news is it's loss-making right now. The good news is that it has $25 million, not just to grow organically, but also do inorganic stuff if it wants, without needing any incremental capital, additional capital from any of the group entities. So it has enough ammo to fix itself, and they have a pretty solid team in place now. I was just with them in June. So I'm pretty happy with the progress they're making.
So at least the 4.5% expectation that you're talking about on the international business, that is taking into account of Henderson pulling margins down, right?
No. Again, let me clarify. Please look at it from FY18 onwards. Before the Henderson acquisition.
Yeah, that I understand. I'm just saying that since Henderson
Just hear me out. Before the Henderson acquisition, the EBITDA margin for international portfolio was 4.5%.
Mm-hmm.
Henderson came, it went up to 5.5%.
Mm-hmm.
We figured out that they were non-compliant in a lot of ways, regulation-wise.
Mm-hmm.
Henderson's higher margin rate actually came down. You follow? So if you want to compare apple-to-apple comparison, please do it without Henderson.
No, see, I'm just, so my question, rather my follow-up on this was, at the current juncture, where are we in Henderson profitability? We are still at a loss. It's basically in fixing mode, right?
Yeah, Henderson is a loss, like I said.
So once that comes to, say, maybe like a sustainable 4-odd%, 5-odd% margin, whatever margin that business is, overall, so basically the international business margin will still be at a 4.5 to 5% bracket once Henderson comes back to whatever is normal profitability.
Absolutely right. That's exactly what we've guided towards since we got listed 21 quarters back. In the international markets, 6% EBITDA margin is going to be hard to get. 4.5 to 5% in international markets is what we should consider as a normal EBITDA level. Number one. Number two, please bear in mind that as the share of international business in our overall revenues reduces, overall consolidated margin for the business will look better because larger chunk of the revenue and profits are coming from India and not from international markets.
Yeah, sure, that I get. And I'm assuming the India business is ideally a 5 to 6% odd margin business on a sustainable basis in the longer run.
Correct. So, I mean, just to summarize for benefit everybody also, international business we should take 4.5 to 5% is the stable margin line. And for India business, we should consider 5.5 to 6% as the stable margin performance.
Okay, thanks a lot.
Thank you. Next question is from the line of Kaval Shah from Banyan Tree Advisors. Please go ahead.
Hi, good afternoon. So I had one question. What is the status on SIS Ventures? Because I think we had invested in one startup. So is there any other investment in the pipeline?
Yeah, I'll take that. This is Bharat. SIS Ventures, as I think we communicated earlier, the board has allocated 75 crores to make investments into companies that have adjacencies with our business. The one investment which has been already made is in StackU. Currently, where we are is we are in the process of evaluating, some other companies. There's nothing yet at an advanced stage that is, past term sheet stage into diligence. We are in some discussions, but there's no particular time frame as such for that 75 crores. It really depends on the types of opportunity that we come across. But certainly the intent is to make a few more acquisitions in the course of the coming year. Not acquisitions, I mean investment first.
Okay, thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Vidit Shah from India Infoline. Please go ahead.
Hi, thanks for the follow-up. Just one clarification or data point that I needed have, which is this one SIS initiative of yours, I mean, what would be the revenue contribution, currently, and where do you see it going up to over the next few years?
But out of 950 crores a month that we are doing, including cash, one SIS would not be adding even 1% of that today. But over time, I see it to be adding, mid-single digits.
Okay, and this is our margins on this significantly better than the 5.5 to 6% that you stated?
As of right now, I would like you to assume that the margin range is broadly the same as the India margin range.
Okay, fine, understood. Thanks for the follow-up.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Alok Deshpande from Edelweiss Securities. Please go ahead.
Yeah, thank you for giving another opportunity. My question was for Devesh on the tax bit. I think you did mention that if the growth continues, then the tax rate might be lower. But do you think that it will be? I mean, given the growth that you are projecting in security, India security, and the facility management business, that will be sufficient to knock off or offset the tax from the international business?
So let me just clarify. I had mentioned that the deferred tax asset creation will be at least 6 months going forward if the growth continues. Now, as far as the offset is concerned, unfortunately, we cannot offset the tax liability, so international will have its tax expense. India will have its tax expense. But because of the offsetting nature of the deferred tax asset, it might be close to a zero rate overall. But we still have to pay the tax in Australia, irrespective of what benefit we get in India.
Sure. So you're saying at the group level, effective tax rate might be closer to zero, is what you're saying, but 23.
Yes, could be.
Okay. Thanks, Devesh, for the clarification. Thanks.
Thank you. Participants, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Rohan, a retail investor. Please go ahead.
Yeah, hi sir. I have 2 questions more. First is how SIS is trying to get more and more clients, more and more big clients. And second is, can you guide us on what will be the revenue growth for next 5 years?
So SIS has one of the largest sales force in the industry. We have more than 350 sales resources. Plus, we do a lot of digital marketing work. We also have a back-end call center to cultivate leads. Through all these means, we approximately meet more than 2,000 prospective customers each month. That's our bandwidth for reaching out and getting large customers. Our focus is also segmental. We focus on certain segments more, and we are always trying to chase higher ticket size contracts. Our entire sales incentive program is built on higher volume and higher margins. That's how you get maximum benefit of the incentive plan. The entire sales force management is done through a proprietary software called SalesMax. So that's how we are planning to build growth organically. As regards to next 5 years, what our growth will be, while it's hard for me to forecast very specifically, the general guidance we have given and maintained since we got listed in FY18 is that SIS aspires to target 20% growth, 20% return on equity, and 50% OCF to EBITDA. these are the three benchmarks or markers against which we measure our performance.
Okay, thank you, sir. It seems great numbers. Thank you, and all the best.
Thank you very much. As there are no further questions, I would now like to hand the conference over to Mr. Rituraj Sinha for closing comments.
Thank you, everyone. I think great set of questions, and I really appreciated it. Appreciate your time today. It has been a pleasure to interact with you. On behalf of Bharat and Devesh, my colleague Harsha, I once again appreciate your continued interest in SIS. As we had indicated in the past, we have kicked off FY23 with a pretty solid Q1. Our order pipeline for Q2 is strong. In short, growth is back organically. Margins will take 3 to 4 quarters to normalize. I have already indicated that international will normalize around 4.5–5%. India will normalize around 5.5–6%. Broadly, that's the trajectory we think we will head towards. As regard to cash, as we grow rapidly on an organic basis, the free cash generation in the business will contract. So please prepare for a lower than 50% OCF to EBITDA this year. If the OCF to EBITDA is higher, that means we didn't grow enough. So that's the way I'm looking at it, and that's my broad guidance. I hope this is helpful. Thank you once again, and I look forward to catching up with you next quarter.
Thank you very much. On behalf of SIS Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line. Thank you.